Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:12 a.m. Central Time, and I'm recording this in preparation for the market day of December the 28th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So, back into the regular saddle. We had kind of a holiday week this last week, and things were pretty much disrupted. Not all the market participants were in play. Certainly, Friday was an outright trade holiday. Thursday was a half day. Today will be the day that, in quotes, most market participants will come back. And I say most. Actually, this week will also probably be a light volume week with some market participants missing in action. So it won't be until next Monday's action that we'll kind of have everybody back to their trading desk. So just kind of keep aware of that. This week should be more normal than last week, but we'll still have some disruption in the force, as it were. In terms of overnight action, and this is based on Thursday's futures closes, we're down about 10 points at the time of this cut, or about 0.5%. Russell's down about 1/3%, Nasdaq's down about 1/3%, Dow is down about 0.5%, crude oil down about 1/4%, euro up about 0.3%, bonds up about 1/4%, and gold is down about 0.5%. China is about 2.5% down, Hong Kong down about 1%, Japan up about 0.5%, and Europe quite mixed, with Germany down about 0.8%, United Kingdom up about 1/4%. In terms of macroeconomic reports, today will be quite light, and indeed Great Britain, I just read off Great Britain. That's actually 12/24's activity. Great Britain is closed today, and then Canada is also, looks like it is closed probably as well, with the bank holiday up there. So there's going to be some market participants that are still missing. In terms of tomorrow in the U.S., good trades balance is coming out, and then the consumer confidence report will be out during the market day. We will have a shortened week again this week, with Thursday being a half day, though there'll be a number of unemployment claims, the weekly variety and stuff like that. There'll be a number of macroeconomic reports released on Thursday, but it'll only be a half trading day, and then Friday again a market holiday. So just be aware of the changes going on for this week. In terms of market conditions, volatility has really been coming down. Short-term VIX down to a 13.64. The skew is also down from some of the levels that we've seen of late, 128.8. IV percentiles, look at these numbers. Then they're likely to continue to get lower this week. We're likely to see some pretty low volatility readings. IV percentile for the SPX is a 19. For the Russell 15, the Nasdaq a 16, and the Dow a 21. This right here, -1, is referring to Wednesday's action. We did have 3 of the 4 indices with standard deviation moves, and we continue to have that polarity between volatility telling us that there's little fear in the market, and in quotes, little volatility, and yet at the same time, from a price action standpoint, we've had 6 of the last 6 full trading sessions now in the S&P with at least a 1 standard deviation move. So you could see there can be a very different answer when you talk about volatility in terms of price action, and then in terms of what the market makers are pricing in terms of fear premium. Very little fear premium right now, but plenty of price action, and much of this is actually two-sided. So let's go ahead and take a look at those charts. And you can see here recent trading sessions, some big bodies here. Really, it goes back to 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 of the last 10 sessions. And remember, this little body here is the half day. But a lot of big bodies here, really going back for 2 trading weeks. And when it's all said and done, if we go back to where these big bodies kind of started with this one here, so you would have started that day at 204.7, we'll call it, and you would have closed on Thursday at 2060, so 13 points in the SPX difference, despite having gone, all those standard deviation moves back and forth, really have accomplished nothing. In terms of the larger trading patterns, this is just a sideways consolidation pattern. Albeit, don't particularly like that it's dipped down here. We've gotten a lower low, but then we got a lower high, and then a higher low, and it appears to be setting up for again a lower high. So we seem to be setting up for some sort of triangle, or I guess we call that a triangle pattern, though not a very clean one, in that it's not like it's got a clear trend and then establishes a triangle pattern and then you see it as a continuation. This is really more of a consolidation and sideways trading pattern that really goes back several weeks now. And that's how it's probably best seen, as a consolidation and transition phase. Where we go from here, with the seasonality of this week, we likely will see some drifting up during the course of the week. We'll have some window dressing, some tax sales still being accomplished during the course of this week. So there'll be likely some continued volatility, and yet at the same time, be kind of hard to believe that we will see a significant new swing high, bringing us up here to this 2120 area, or that we would see a breakdown below this we'll call it 1993 area, certainly below 2000. I'd be surprised to see either one of those extremes this week, but we'll see what the market actually delivers. In terms of the other indices, Dow very much like the S&P, lots of chop. And the NASDAQ, well, it's a little slow on the paper trader there, but also a sideways consolidation pattern. Russell, a little bit more of a bullish action. You take this whole last week was basically straight up, and that one has been, in relative terms, in the short term, stronger than the other indices. We'll see what happens with this Sunday night into Monday morning weakness, if we can continue to hold up with some strength coming in on that Russell. In terms of volatility, let's take a quick look at that. And you see current live volatility futures are still kind of playing in that 18 to 20 region, so higher than we like to see. Certainly not a strong bull or anything like that, in that we like to see volatility down below an 18. It's not there. It's a little elevated, and yet at the same time, not a lot of fear premium putting in. And we're below the cloud, and all these kinds of things are very, very sideways. Look, the future cloud here is twisted, but very thin, and looks to be about ready to twist again. So we are really, really quite benign in terms of the amount of fear that is being priced into the market at this time. And then let's go to bonds. Bonds also in a consolidation pattern. Nothing really here telling us which way this is likely to break out. If we go back in time, this is a big sloppy consolidation pattern. You could draw some kind of triangle kind of patterns here, perhaps even make this into something of a triple bottom with a kind of an ascending triangle kind of pattern coming together at the top, but doesn't seem to be ready to precipitate any significant action one way or another. We'll likely see all these markets break to one side or the other after the new year is the best guess at this time, but obviously the market will do what it wants to do. That should be enough on that right now. Let's go ahead and go to the daily report. And still IBD status, uptrend under pressure, accumulation distribution, still a very ugly D minus in the S&P, the NASDAQ a D. GMI index is up one notch to a 2 out of 6, but still in a full out sell signal, and that author remains 100% cash. In terms of the stock charts, decision point scoreboards, we still retain this very ugly short-term pattern and very mixed overall picture with this poor short-term pattern, a bullish intermediate pattern, and a very mixed long-term pattern. When you put all this together and you make something of a consensus out of these various mechanical signals, you'd have to say that the portfolio investor posture is still in transition. We have, for most of recent weeks, said that transition with a bullish bias. Right now, I'd start to say a transition pattern with a bearish bias, but we may not really know the real answer to that pattern for another week or so. Intermediate term market posture is bearish with a slightly bearish sentiment line. You see the position sizing opinions getting fairly defensive here, 50% on the portfolio investor position sizing opinion, however 75% based on volatility. In terms of that intermediate term market posture, you see the most important market, the S&P, is outright bearish. Dow and NASDAQ also bearish, though Russell retains a fairly weak bullish stance. Hedge warning status remains pretty significantly elevated with a level 2 on a 0 to 3 scale. This is our yellow light, we think, in terms of being fairly dangerous conditions when we have level 2, elevated risk levels. This is not a prediction that the market will fall, nor how far it will fall, but it is certainly saying that the conditions are there, that we could have significant failure by the bulls given these conditions. And you can see the equity risk short term is a 7, relatively elevated there. Intermediate term, a more even 5. In terms of the special measures, most of these have ebbed off in recent trading. We still have a daily squeeze present on the VIX. We still have a ratio warning set up potentially. We also have that skew, which is running, and it's actually about above a 125 for about a 7% probability of a 2 standard deviation move. But remember, when we looked at that, the last 6 trading sessions that were full day trading sessions were all more than 1 standard deviation move. So these elevated skew ratings have definitely been followed through by the price action. These have lived up to their probabilities of higher than normal movements. And while 9% or even 7% doesn't sound very high, remember normal is less than 2%. So these are factors of 4, 5, even 7 times higher than normal market conditions for 2 standard deviation moves. And we've definitely been seeing that in recent price action. In terms of the risk aversion indicators, we have 4 of the 5 as risk off, so that's still very much of a warning. Fear and greed index still also in a fearful stance. In terms of special opinions, be very defensive continues to be the watchword. VIX is inside the acceptable window to initiate new positions for novice traders, but be defensive and cautious about opening new positions. Consider reduced position size. The market has been chopping in and out of the acceptable window for novices. Obviously, more experienced and aggressive traders will find these elevated premiums that are available with higher VIX levels quite helpful to their trading. You just got to be ready for additional delta and vega moves. And for novices, this is not the easiest market conditions. Cover call strategies and put selling, while conditions are acceptable for these based on our signals, they have also been chopping in and out of acceptable thresholds. Be quite defensive about your positions and use some of the suggested defensive tactics to be able to lessen the risk of those positions. Be careful about how long you wait, what size targets you take to exit positions. Consider shortening up those targets, taking some position off earlier, and then perhaps letting the rest run if the market should develop into something more bullish. In terms of sector Pacific, you see with the recent action, it's generally positive with some neutrals in here. Certainly not the sea of red that we saw a number of trading sessions ago, but also remember that an awful lot of these indicators and market postures and so forth are relatively flat. This is a very, very flat market, and as such, many of these indicators are just getting whipsawed right back and forth, and what looks like a go signal the next day is a failure or whiplash, and that's the market you're in. So don't make too much of some of these signals in this kind of a market condition. Percent change, you see very, very strong action on the last full trading session. With energy up over 4%, and even consumer discretionary and the least strong sector was up over 0.5%. In terms of the relative rotation graph, this is another warning area. Notice how very little is up here in this up right-hand quadrant, and even those that are up in that quadrant, only the NASDAQ really is kind of moving with strength, in the pattern that's going towards the upper right. The Dow, of course, is in the upper right, but is tailing off. So not a lot of indices or industry groups or anything like that that we would normally see in this relative rotation graph to get excited about. This is really quite a weak pattern overall. So that should be enough for today. We'll get back into our regular swing of things during the course of this week. This week will continue to be a very good week, though, to do some of the study, analyze your the strategies that you've been working for the year. What kind of performance have you been getting? Are there some strategies that perhaps need to be dropped for 2015? Are there other strategies that maybe are lacking and need some more work? But take a look and use this week of likely slower trading to continue to do those special studies of performance work that is very well founded during this final couple weeks of the year. In terms of some of the special programming, I will be releasing the description for the Cover Call Mastery course this week. Probably in the next day or so, just as I get back to my normal trading desk and get everything kind of settled out. But do expect this to be generally released this week. I am looking very much forward to teaching this class. I have put a lot of work into the development of this course, and it's meant to be a multiple week course and a very, very comprehensive, and that's why I say mastery course. And really, if you've ever wanted to learn about options, the cover call strategy, of course, is one of the very first things that you would want to learn, and it's a great introduction to trading options. But I will also be trading and modeling and teaching around concepts of stock screening and portfolio management and all these different kinds of concepts and so forth. So it's going to be a very good kind of intro course to being able to not just look at how to address the market, but also an introduction in effect to options through the use of the cover call strategy. By the bottom of this whole thing, you'll have a complete rules-based trading strategy around cover calls. And I expect to roll that course out at the end of January, and it'll run for several weeks using Saturdays. This will be available to both in-person and virtual attendees. So if you're in Chicago, great. You could look to attend classes live. If you're not in Chicago, we'll be doing this in a simulcast and have recordings and all that kind of stuff so that everybody can participate no matter where on the globe you happen to be trading from. If you'd like to get your name on the list the distribution list for more details to be sent to you when they are available. Just send me an email at steven@falconglobaltraders.com. As always, if you find that this is helpful to your trading, this regular morning market preview, you can certainly subscribe to the YouTube channel, like me on the YouTube channel, and also retweet to your Twitter followers, to your StockTwit followers. All those things encourage me to continue to produce. Disclaimers as always, hit the pause button if you need more time to review, and then you see the hyperlink there for the full disclosures. We'll see you back here tomorrow morning for the market preview from Falcon Global. Good trading.